First up this morning is an audit and accounting professional update. It's going to be led by Erika Deiseroth, a manager in our A&A group, and my partner, Jeff Ford. So without further ado, I'll get these guys up here and get started. Hope everybody has a great day. Thank you again for coming.
I want to continue the thank you that Bob mentioned and say that Eric and I are looking forward to talking this morning about new developments in A&A. And I'm confused every year why we need both caffeine and accounting standard updates, because that seems to be redundant as far as stimulants are concerned. But before we dive into that, I do want to recognize that certain things are more important than CPE or than our businesses and so forth. And I think I'm motivated to do this by continuing what Bob mentioned about recognizing our veterans, and also recognizing that just a few hours ago, just about 2 or 3 miles from here, a police officer was shot in the line of duty. So I thought it's appropriate to recognize those who serve us. And basically, as I was thinking, I just jotted down a few words, so I'll only take a minute of your time. And as the years go by, the deeper really becomes my sense of gratitude for so many things, and certainly including the blessing and the privilege of this firm, the people I get to work with inside the firm, and the people in this room that I get to work with. But notwithstanding all of that is the privilege of living in this country and the freedom that we enjoy here. And Bob recognized the veterans. Bob is in fact a veteran. He didn't stand up because he was already standing. So in recognizing our veterans and those who serve, like the officer who was shot a few hours ago, I brought the words of a veteran who I believe embodied the spirit of the American serviceman and woman. This was written by Colonel William Barrett Travis. The Texans in the room will know who he is. And he was writing this from the Alamo on February 24th, 1836. And he wrote, "I am besieged by 1,000 or more of the Mexicans under Santa Anna. I have sustained continual bombardment and cannonade for 24 hours and have not lost a man. The enemy has demanded a surrender at discretion, otherwise the garrison are to be put to the sword if the fort is taken. And I have answered the demand with cannon shot, and our flag still proudly waves from its walls. I shall never surrender or retreat. Then I call on you in the name of liberty, patriotism, and everything dear to the American character to come to our aid with all dispatch. The enemy is receiving reinforcements daily and will no doubt increase to 3,000 or 4,000 in 4 or 5 days. If the call is neglected, I am determined to sustain myself as long as possible and die like a soldier who never forgets what is due to his own honor and that of his country." And that's in fact what Colonel Travis did. So once again, a thank you to all those who serve, the officers, the veterans, and so on. So thank you for that moment. Now to the A&A update. Once this is moving the right direction. There we go. We have a few objectives this morning, and it's really to cover the accounting pronouncements that are either newly applicable or soon to become applicable, or some that are being contemplated or recently enacted. So we're really going to highlight those changes and to highlight certain recent changes. And there are 2 big elephants in the room that Eric and I will cover, those being leases and revenue recognition. And we'll save revenue recognition for last. So as we're going through it up front, no worries, we won't forget revenue recognition. We're also going to avoid several things. We're going to avoid talking about IFRS. We're going to avoid talking about SEC and PCAOB matters. We're going to avoid specialized industries. We're going to avoid most of derivatives and hedging. We're actually going to avoid auditing standards. We're going to focus on the accounting standards. So what about the things that are coming up soon, applicable now or soon? Well, we have a number of things along those lines. First of all, we have extraordinary items. I don't know how many of you remember extraordinary items from business school. I think it was probably even intro to accounting or maybe intermediate accounting. Some of the professors in the room would remember. But that was something that you studied and you learned and you knew how to do the unusual and infrequent test. And then you got into practice and it never happened. You'd have big things like floods and strikes and wars and rumors of war, and there was never an extraordinary item. So at long last, the standard setter said, let's do away with extraordinary items. So they are now gone, or at least they are gone for all periods beginning after December 15th, 2015. So for all intents and purposes, extraordinary items are behind us. Now, what about consolidation? This one is the area this year where the FASB always plays with me. They always issue something after my slides are done and given to Mary Lou, and they did it again a couple of weeks ago with another accounting standard update regarding consolidations. But it really is, kind of dovetails nicely to this one. But ASU 2015-02 did some nice things. And it really kind of overrode a presumption that was out there. And that's how to treat general partners in a limited partnership. And most of you will remember that by definition, a limited partner really can't be directing the activities of an entity, or they're not limited. They lose that limited status. They lose the protection of that limited status. So by definition, a general partner was at least breaking the first test as to whether or not you had to consolidate a variable interest entity, and that would be directing the activities of the entity itself. So that is the definition of a general partner. And the second test for a VIE consolidation is whether or not that beneficiary had to absorb the losses of the VIE and some things along those lines. So I think there's some reality that was reflected upon, and it was determined that the mere status of a general partner in a partnership does not, in and of itself, require consolidation by that GP of that entity in which there's a GP interest. Nevertheless, the other tests still need to be evaluated. The GP may still be required to consolidate the VIE, but not merely by virtue of the status as a GP. So now in October, the FASB threw out ASU 2016-17 that also had to do with consolidations, and what it's about to do, although it won't be effective for years after 12, 15, 16 for public companies, 17 for private companies, it really allows a little bit of helpfulness in the measure. When you're looking at the interest in these variable interest entities, it makes sense that the beneficiary needs to consider all of the direct interest. Direct interests, like direct costs, are always considered, right? Well, now what do we do with the indirect interest? Kind of like allocating direct costs. Now, historically, you look at all of the direct interest, and the new ASU is allowing us to proportionately allocate or look at the beneficiary's indirect interest in that VIE and evaluating the need for consolidation. So that's kind of helpful and neat, and perhaps a little bit long in coming, but very, very nice. Now this one is going to be, I think, one of the more challenging ones. I think it was a little bit less talked about than some others, but I think it has a lot more challenges to it than some people have recognized. And that's ASU 2015-05 with regard to internal use software. There is a long-standing old FASB and statement of position that really govern software for resale and software for internal use. They were written long before this whole concept of the cloud and subscriptions. So now a funny thing happens, and again, just stepping back a second, talking about how software licenses are dealt with. First, from the standpoint of the seller of a license. The seller of a license treats their recognition of that revenue based on really two factors. If it's an indefinite license, sort of like my Microsoft Office that has an indefinite license, I can theoretically use it forever until they call me and make me send them more money. But then the seller of that license recognizes all the revenue immediately. If that software license had a 5-year term, it's recognized ratably over the 5 years, right? Now on the other side, if you're the buyer of that software license, it's basically a PP&E item, just another fixed asset. Falls under your fixed asset capitalization policy. Well, that's pretty clear until along comes the web and these subscription agreements and these long license agreements that almost nobody reads. I, like most of you, have probably clicked I agree. And now lately they've added another click, and hopefully the lawyers won't yell at me for doing this. And they'll say, have you read this? I'm like, oh yeah, I read it. Click, click, click. and if you do read it, which I have done a couple of times, it's torturous. And you're not sure what's in there or not in there. The only thing you know for sure is you have to send them money and they have no responsibility. But now, I think auditors and financial managers are actually going to have to think about these things. Because to the extent that it's a true subscription, think Salesforce or NetSuite, where you barely own your data. You own the content, but not the data vehicle itself. And if you leave them, they'll give you a CSV file dump, and they're updating it whenever they want. You can't even reach the code, and so forth. That's a true subscription agreement. And that's really an expense as you go, kind of like an operating lease. Thankfully, kind of like operating leases will still resemble. But on the other hand, if there's an element that's a license, think some of the products that still call themselves cloud products, whether that's Microsoft Dynamics for the so-called cloud or Sage 100 for the so-called cloud, or even Microsoft Office for the so-called cloud. Those are actually license agreements. If you read them carefully and you have the opportunity to move the software around, they're license agreements, and the FASB now requires us to kind of differentiate between the subscription components, the software agreements, and the license components, and to treat them accordingly. And that's really, unfortunately, now effective. I wish we had another year because, as I said, a lot of folks really hadn't thought about this one. Well, what about fair value measurement? We can't have a presentation without at least one of these slides talking about fair value measurement, because it has been really an obsession of our industry for the past 10 to 20 years. This is an interesting one in the sense that it really allows kind of an expediency for certain investments that, now I completely lost my place, as you could probably tell. Well, that's embarrassing. So I'm going to come back to that one. And I would talk about interest first. I think we'll talk about the interest cost first, where we have the change in the interest cost. This was really one of the easiest ones to apply for a period of years, and this was deferred financing costs. Deferred financing costs were capitalized, they were stuck in other assets, and they were, of course, amortized over the life of the related debt. That was very simple. Even non-financial people can understand it. I said in a different presentation, even my daughter, the biology major, could understand, hey, you paid the bank, you paid the lawyers this much to get the debt in there, so you just write it off over the life of the loan. They grasped that. But instead of enjoying that, our standard setters decided to be more academically correct. And they are, in fact, much more academically correct. And they have chosen to go back to that chapter in intermediate accounting that drove most people out of being an accounting major. And just remember, what was everybody's favorite chapter in intermediate? It was probably bond premiums and bond discounts, right? I'm sure some of you are sitting there thinking, no, I didn't have to study for that one. I didn't even have to read it. Interest, premiums and discounts, that's intuitive. I don't really have to worry about it. Well, it really is intuitive once you think about it long enough, but most people outside the financial industry don't. And this really is technically accurate in the part of the standard setters, because debt issue costs are really part of the borrowing cost. They really do affect the fair value of that debt instrument, just like a bond premium or a bond discount. So in appropriate application of technical theory, the standard setter said, gee, these really aren't assets that should go in the asset section of the balance sheet. They are really reductions of the face value of the debt that should be treated as interest or borrowing costs over the life of that debt and amortized in as interest. And that's completely correct, but I assure you we just now lost my daughter's ability to follow the concept. So many, as they've adopted this, have found it helpful to put a table in the disclosures that actually shows the true face value of the debt, the impact of the deferred financing cost, and then the fair value of the debt as presented in the financial statements. How about going concern? Going concern is one of those things that we've always talked about. Going concern strikes you really from a couple of different perspectives. Going concern, interestingly enough, has never been part of the accounting standards. It's always been an auditing standard. Think how awkward that is. Management had no responsibility in this regard, but the auditor did. That becomes increasingly awkward as the auditors are required to be more and more obsessive about our independence and really can't even begin to flirt with anything that resembles a management decision or management assessment. And there was also this other handy tool that auditors love with regard to going concern, and I think companies did too. And that's what to do when there is some question about the ability to continue as a going concern. And the company really was loath to issue statements with a going concern qualification in the opinion, which is often understandable. So the neat tool we used to have in the toolbox was that if we're still working on the 12/31/15 statements, and it's now November of 16 and not done yet, and we're still debating this need for a going concern qualification, well, the solution was simple. Let's just issue them in January of 2017. By January of 2017, if the company still exists, there by definition can't be substantial doubt at 12/31/15 about its ability to continue for 12 months. So problem was solved. And that's a tool that was used oftentimes for many, many decades. And this has now changed in a couple of profound ways. First, going concern concepts have been introduced to the accounting standards rather than merely in the audit standards. They're definitely still in the auditing standards, no change there to speak of. but they're now management's responsibility. It becomes another one of management's assertions. So now rather than us an auditor evaluating an entity's ability to continue as a going concern, we're doing what probably should have been happening all along. We're called to evaluate management's assertion as to that company's ability to continue as a going concern. Because remember, we're supposed to be opining on management's assertions rather than creating assertions of our own. So now that's clearly codified and explicit. Management makes the assertions regarding an entity's ability to continue as a going concern, and the auditors audit those. There are more disclosures relating to that continuous, but there always have been a lot of disclosures available for that. But then another funny thing happens with going concern, and that's the 12-month period has been moved. Instead of 12 months from the balance sheet date, it's now 12 months from the issue date. So in my story a few moments ago, where we're still wrestling with the 12/31/15 statements for a given company, and we're about to issue them soon, and we're going to say, let's just issue them in January of 17, we now need to look at that entity's ability to continue as a going concern until January of 2018. We're now back to doing what I guess was intended to be happening all along, and that was really providing the users of the financial statements with some ability to really contemplate that situation. Now I have one more comment, because you get both facts and comment this morning, at least from this side of the podium, and that is that going concern is an awkward situation. I've kind of joked with my partners over the years that if I look at the population of entities that we've audited, where our staff and seniors and in-charges have wanted to attach going concern opinions, that population is very wide, reasonably wide. If I look at the number of those who actually failed over a 25-year period for which the seniors and the staff thought there should be a going concern opinion, that number is relatively narrow. And when I look at the number that failed within that 12-month period, the number is amazingly narrow. And then I look at those entities that we've served that have actually failed, and in a remarkable number of cases, something turned during the year. It turned quickly. There was an abrupt change in the marketplace, and there really had been no worries about going concern several months earlier when the financial statements were issued. So that's kind of the commentary there, saying that it's not nearly so easy as some may hope for it to be. Now, what about the plan accounting for benefit plans? Well, a couple of nice things have happened for benefit plans, because we'll, in the comment side, talk about the things that are harder to implement. We'll also talk about the things that are very, very helpful. And these developments in pension plan accounting have been very, very helpful in two areas. One, it was always been kind of fuzzy to determine the fair value versus the contract value of a benefit responsive vehicle. Thankfully now, for a fully benefit responsive investment, we can use contract value as the proxy for fair value rather than the other measure. And they were oftentimes not materially different anyway, but this is a really helpful expedient. Also very nice, because the FASB determined it wasn't particularly useful, was the 5% disclosure and the disclosure of investment performance by investment type. And that is now gone. And this has been early adopted quite a lot this past year. It's really not required until years beginning after next month, December 15th of 2015. But an awful lot of plans have early adopted for the year ending 12/31/15, and that's merely the elimination of the 5% disclosure and presenting the investment performance more in aggregate rather than by investment type. We almost always have an ASU or two that has to do with business combinations. There were a couple of them in the prior year, and this one, while it was issued in 2014, is applicable once again for years after, beginning after 12/15/15, so it's applicable for calendar 16. And this really recognizes a little bit of an area that was bumpy for private companies. Just taking you back a little bit, you remember that as they came out with FAS 141 and 141R, you actually had to value all of the separately identifiable intangibles of an acquired entity. And as much as Bob and Melissa and Brad and others in our evaluation services group enjoy doing that, a lot of private companies said, you know, we don't have a lot of these separately identifiable intangibles. A lot of times in the private company arena, company number one is buying its competitor, company number two that it's known for 25 or 30 years. They're saying, why does somebody at a CPA firm need to tell me what the customer relationships are worth when I've known those same customers for decades? And the FASB sort of recognized that and said that, particularly in a private company arena, there's still value to many separately identifiable intangibles. I realize they're public, but the recipe to Coca-Cola still has intangible value, I would like to believe. And in private companies have many things that are similar, trade secrets, proprietary processes, and so on. But with regard to the areas that tended to receive the most pushback, which were non-compete agreements, customer relationships, and customer-related intangibles, the standard setter said, you know, it really does make sense that it's not necessary or helpful to the users to delineate those. So we will allow companies, when an acquisition's separately identifiable intangibles are limited to customer-related intangibles and non-compete agreements, we'll allow those to just be categorized as goodwill, kind of a little bit back to the old school way of doing things. But they added a caveat, since most of you will remember that goodwill is now no longer amortized. It has an indefinite life, so it's evaluated for impairment. But you have an option that came out also in 2014 to amortize goodwill over 10 years. They said, you know, if you're going to throw this in goodwill instead of breaking out your customer relationships and all of those other customer-related intangibles and amortizing them over 5 to 15-year customer life, you can put them in goodwill, but you just have to then elect the goodwill means where you're amortizing that over 10 years. So I think that's actually been early adopted in several of the transactions that several of us have worked on, and I think it's been received with gratitude by those who used it. Here's one that I really didn't think much about before the ASU came out. And that's inventory and the net realizable value. Because normally what we're looking at net realizable value is always the debates on in aggregate or individually and any number of things related to net realizable value of inventory. And cost is an area that I probably focused on maybe more than some, because there are many different ways to measure cost. As those that have done due diligence and acquisition would know, how an entity determines its cost of inventory is a big deal. But also how to determine the net realizable value had a lot of variations in practice. So this really says, no, we're going to eliminate all the variations that are out there, and we're going to say that the market is the net realizable value with a very simple means of achieving the measurement of that. How about some recent changes, some of which can be early adopted, some of which we look forward to? Income taxes is a fun one. A lot of people have enjoyed breaking out current and non-current deferred taxes, but most users, as much as the auditors and the CFOs and the controllers have enjoyed breaking that out, most users of the financial statements really didn't change their decision based on whether we classified a deferred tax asset as current or non-current. So the standard setter said, put them all in non-current. So we have the opportunity to do that now and going forward. I'm going to speed up a little bit so I can hit the leases pretty hard. And we talk about investments with the equity method. And just quickly, a nice thing that happens here is whenever you have equity method investments and you present multiple years financial statements, you actually have to go back and show a retrospective increment earnings adjustments as you increased your ownership. And now we don't have to do that step-by-step retrospective application of earnings impact when you're increasing your interest in an equity investee. There's a whole lot of things to consider for stock-based compensation. I think I dwell on it because it's too small of a subset of the audience that has stock-based compensation. But for those that have stock-based compensation, this is an important pronouncement to look at. It's not effective till years after 12, 15, 17 for private companies, but it really hits a lot of things. It hits the classification of the awards. It talks about a lot of disclosures, talks about tax consequences. There's always been that interaction between the old 123R and 409A, and it also clarifies a number of other measurement items with regard to stock-based compensation. How about the statement of cash flows? This is one that was issued in this past summer, and this is really changing a number of things that we can look forward to a couple of years from now on the statement of cash flows. So really looking for some consistency here. And we're basically saying that in areas where there was a lot of disparity in practice, let's achieve consistency. And those would be debt prepayments. Debt prepayments are clearly defined now as financing activities. I'm going to skip over some. But insurance proceeds, I think appropriately enough, will match the coverage. So for example, business lost profits coverage will be an operating activity. Replacement for PP&E would be an investing activity. It makes quite a lot of sense. Corporate-owned life insurance proceeds, which have become more popular over the last 20 years, are reflected as investing activities. And there are some other considerations and some expanded disclosures. There was a big one that was issued in August as well for nonprofit entities. Some have hoped that this would be a simplification. I'm not so sure that it'll be simple, and some of us have interacted in that regard. Nonprofit entities will now eliminate one of the classes of net assets. Instead of having 3 classes, which are unrestricted, temporarily restricted, and permanently restricted, we'll only have 2 classes, unrestricted and restricted. And while that'll be easier in some regards, I think the nonprofit executives will appreciate the fact that they're going to have a little bit of time, years beginning after December 15th, 2017, which means the year ending 6/30/19 for most nonprofits with the 6/30 year end, they're going to have a little bit of time to think about it because there are going to be a lot more disclosures. There are going to be disclosures regarding the basis of recognizing those net assets as restricted or unrestricted, the concentration of certain donor restrictions and the ability to monetize those, the ability to spend those. There's going to be more disclosure regarding the cost allocation procedures, and probably most onerously, liquidity management, cash management and liquidity management, and whether the entity is essentially borrowing from the restricted funds to fund operations. So that'll be an interesting one, applicable in a few years. So with that, I'm going to jump forward a few slides and talk about leases, and Erika will pick up shortly with the revenue recognition. So with regard to leases, we've had 10 years in the making. 10 years of wrangling, a lot of exposure drafts, a lot of worry about those exposure drafts in the FASB and the IASB's zeal to kind of get rid of off-balance sheet financing. FAS 13 had been around since 1976, so it was relatively long in the tooth, but a lot of people thought it did a pretty good job. And a lot of analysts thought they could still determine the prospective cash flow of a company by virtue of the disclosures in the financial statements. Regardless of what you thought, we have a new standard for leases that's becoming applicable a couple of years out. And we're going to have to change our terminology a little bit, particularly for lessees. Lessors' lobbies really won in the US. They didn't win so much in the international standard setters. The US standard looks a lot like the existing standard from a lessor's perspective. But we'll have to learn a couple of new terms. We're going to have to get rid of the term capital lease and use the term financing lease. So you have operating leases and finance leases. Same concept as a capital lease. Really, most entities aren't going to escape this. It applies to all companies that engage in leases, including subleases. There are some scope exceptions that we'll talk about in a few minutes. The criteria is really pretty similar, but they took away a couple of things that Americans in particular love. We love to be rules-based rather than principles-based. And the criteria that you remember for capitalizing a lease was, was there a bargain purchase option? Was there a change in ownership? Was the initial term longer than 75% of the useful life at inception? And did the present value lease payments exceed 90% of the fair value at the inception of the lease? Well, most of those concepts continue in the new pronouncement, but they're changed a little bit. The bargain purchase and the transfer of ownership remain. They took away our percentages, but the concepts remain. Instead of having 75% and 90%, you now have words like substantially all, most, and things like that. So I think as the implementation guidance probably comes out in the coming months, you'll see more and more ability to kind of narrow down what that means to avoid too much inconsistency in practice. They also added another one, which is probably superfluous because it's probably not going to trigger many capitalizations that wouldn't have happened from the other criteria. And that's one that says if there is no alternate use for the asset to the lessor after the end of the lease term, it's for all intents and purposes a finance lease and would be treated accordingly. How do we determine the classification of these leases with the criteria we mentioned a minute ago? Well, a lot of it stays the same. The liability, we're going to record, and this has been talked about several years, so I didn't dwell on it. The lessees will record a right of use asset on their books for both finance and operating leases, and an offsetting liability. The right of use asset will be amortized along the way that we'll talk about in a few moments, and the liability will also be amortized coincident with that. Finance leases will be treated remarkably similar to capital leases. But how do we determine that rate? Well, the rate determination to determine the treatment of the lease really does remain substantially the same. We had the choice between the implicit rate in the lease or the company's incremental borrowing rate, and those choices remain. They've added a third choice, and that is a company can use the risk-free rate. But think about it. The risk-free rate, which is basically the government treasury rate, is going to be lower than most companies' incremental borrowing rate, and certainly lower than any solvent leasing company's implicit rate in their leases. So that would rarely happen and would trigger a treatment as a finance lease more often than not. So consistent with the revenue recognition and consistent with other changes to the standards in recent years, they've brought the treatment of the initial direct costs and the indirect costs with leases a lot more in sync with the other standards. The indirect cost would be capitalized just like they would for another contract. To the extent that those costs would not have been incurred without the happening of that lease, then they would be capitalized and amortized over the term of that contract, because leases are deemed to be a contract just like many other contracts would be. Talked about the concept of operating and finance leases. And operating leases will be a straight line amortization of the asset. There's still some open questions as to the impact on EBITDA, because now we have an amortization item per se rather than an operating expense, but I think that'll be tweaked. I think it'll be adjusted. And some other things that were talked about here would be the impact on debt covenants, particularly leverage ratios, debt service coverage ratios, because the definitions will need to change a little bit. I think the standard setters assumed that the lenders would quickly amend the definition of the covenants. I'm not so sure about that. I think it might require a little bit of actual rapport and interaction between the borrowers and the lenders, but it is clearly achievable. On the finance side, we still have the same interest in depreciation components that we've always had. But we also have something else that the lessees will need to do. Whenever you are recording a right of use asset, and there was no asset previously for that type of category, you now need a policy. There's a de minimis feature inside, well, it's actually not in the standard itself, but it's in the commentary. So if it's a $50 lease for the polar water equipment, presumably you don't have to do this right of use asset. So it stands to reason that companies should have a policy for their operating leases, and the right of use asset capitalization probably very analogous to their PP&E policies. How about lessors, as I jumped around a little bit? Very few changes there. There's a little more conformity to the revenue recognition standard, which Erika will talk about in a few moments. They got rid of leveraged lease classifications, but leveraged leases never happened anyway. And the leases now will be classified still as direct financing leases or sales type leases. Of course, the only difference there is the producer's or seller's profit for a sales type lease is recognized ratably. We already talked about most of the important matters, so I just hit a few other ones as we go. We do need to consider the term and all likely renewals. You can't get away with the month-to-month situation and saying, gee, I don't have to even think about this because it's a month-to-month lease. If it's a month-to-month lease that you know it's going to be renewed, you have to go back and make sure that all of the likely renewals are contemplated. You need to remeasure the leases for any changes to the terms or other financial elements of the lease contract. That's really important, and I think the standard says recognize there's going to be a lot more remeasurement than currently anticipated. We've talked about indirect costs, we talked about direct cost. Bundled leases, of course, are going to be disaggregated. We're disaggregating everything now from just like we do in revenue recognition. Certain things are really refined. The sale leaseback guidance is refined. The operating, leases with related parties is refined to really reflect only the legally enforceable elements of those related party leases. And the built-to-suit guidance will annoy some people because this word control has replaced kind of risk of ownership and enjoyment of ownership. And now if an entity has control of a property that's being built to suit, it might have to be capitalized on the buyer's, not the developer's books. We don't have to apply this to leases of intangible assets, biological assets, inventory, or certain natural resources. So, well, this is effective for years after, beginning after 12, 15, 19 for private companies. We will be thinking about early adoption in some cases. And the last thing before I hand it over to Erika is they have a funny adoption method. It's basically a modified retrospective approach. Full retrospective approach isn't even permitted, it's prohibited. And this merely says you look at all the leases in place at the day of adoption and you flip them to the new method. So look forward to some continuing guidance on leases. And now we look to Erika for revenue recognition.
Okay, guys, so we're gonna talk again this year about revenue recognition. I did present on this same topic last year, and the first part of my presentation, I'll be going over some of those same things that I went over last year, where I'm talking about ASU 2014-09, which is the revenue recognition standard. Then my second half, I'll talk about some updates that has arisen since this guidance came out, which was August of 2015. We'll go from there, talk a little bit about some industry-specific happenings, as well as a summary and then some takeaways from when we're moving on into our next presentation. So ASU 2014-09. I think this number is important enough to know, to keep in mind. This is topic now 606. Topic 605 is no more. Where I'm going to refer to this throughout my presentation as the revenue recognition standard. So this is what I'm talking about when I say that. This is a converged standard. It supersedes a lot of the guidance that's currently in the accounting standards codification. Most industry-specific guidance has now gone away, interestingly enough. So we'll talk a little bit about now what specific industries are doing in response to this converged guidance. Okay, moving into some goals of ASU 2014-09. You'll see them there up on the screen. They sound like lofty goals. I think it remains to be seen as to whether these will actually come to be. Now the underlying principle to revenue recognition. There's a lot of words there. Jeff talked earlier about moving from a rules-based to a principles-based approach in these standards, and I think that's what they're trying to accomplish here, is by having an underlying principle to all of this. So you can read it there on the screen. They've also provided a 5-step revenue recognition model, which is here on our next slide. So I would also say that these 5 steps are also pretty conceptual, but then under each one, there are going to be specifics, and I would even go so far as to say rules under each one of these. So I'll go through each one of these steps, and for each one, I will have a keyword to present to you, just so it's jogging your memory, have some idea of what these steps are talking about. So step number 1, it's interesting, these first 3 steps are all about identifying something. So in step 1, we're identifying the contract or the contracts with the customer. So the key word I'd like you to keep in mind here is agreement. A contract is an agreement between 2 or more parties that creates enforceable rights or obligations between these parties. We are identifying a contract or contracts because there's some additional guidance even within this step as to whether contracts can be bundled. In the telecommunications industry, you might have contracts with different customers, but that have very similar characteristics. So getting some guidance on how to account for those. Also, if you have multiple contracts with the same customer, are those able to be bundled or not? So that type of thing is handled under this first step, again with the key word here being agreement. So moving on into step 2, we're identifying something else now, and that is the performance obligation of a contract. So a performance obligation is a promise to transfer a good or a service that is distinct. So 2 criteria for driving whether this good or service is distinct. First of all, it's capable of being distinct. And second of all, it's distinct within the context of the contract. So our keyword for this step is distinct. You sort of have this concept of an element or a deliverable, which used to only be in your industry-specific guidance, but now it's really intended to apply to all types of contracts being entered into. So moving into step 3, the third thing we're determining now is our contract price. So what I'd like you to think about here is consideration. So your contract price is the consideration which you expect to receive after you transfer that good or that service to your customer. So again, you'll see on the slide here, there are some different directives or some different rules that apply. The one that I wanted to touch on here was variable consideration. You might wonder what that means. Variable consideration results when you have discount provisions, rebates, a right of return. And under this step, you're able to use one of two methods to estimate a contract price when there's variable consideration. We have here the probability weighted model. There's actually a most likely estimated amount that you're able to use as well. So moving into step 4, just to take a step back, we've determined the contract or contracts. We've determined those performance obligations, which are distinct. We have also determined our contract price, or that consideration. Now in step 4, we have to allocate that transaction price across those goods or services that we're providing. And this step is telling us that we should allocate that transaction price using the relative standalone selling price. So our key term to keep in mind here would be standalone. Maybe a published price list, something along those lines should be used to help allocate that contract price across your deliverables or across what's called the performance obligations. So moving into step 5, this is where it all comes together. You recognize revenue when or as those goods or services are transferred, when those performance obligations are satisfied. So this can happen either over time or at a specific point in time. And really what's driving that is this concept of control. When does the customer obtain control of that good or of that service? If it's determined that you can recognize revenue over time, you're allowed to use input or output methods to estimate your progress along the way. So those are our 5 steps. Just to quickly reiterate, step 1 is the agreement. Step 2 is that distinct performance obligation. Step 3 is determining that consideration. Step 4, that standalone selling price being used to allocate the transaction price. And then step 5, control. When that customer has control is when you're able to recognize revenue. So we're staying within 2014-09, but wanted to go over a little bit what they say about accounting for contract costs. Time is of the essence here, so I won't go a lot into that, but in general, some of these costs are eligible for capitalization and then can be amortized as the goods or services to which they relate are provided. Also, various disclosure requirements regarding the nature of contracts. There are some quantitative, some qualitative disclosures. Ultimately, the FASB wants to make sure that the readers of the financial statements understand the nature of the contracts that have been entered into, and maybe some of the uncertainties associated with them. Okay, so that was ASU 2014-09 in a nutshell. There's a lot there. But since then, some additional technical guidance has been issued. I think you all are probably fairly familiar with the first one, ASU 2015-14. So that defers the effective date of this standard by 1 year. So if you're a private company on a calendar year and you're talking your annual statements, December 31st, 2019 is the year that this will need to be implemented. If you're a public company, it's 1 year prior to that. ASU 2016-08, principal versus agent considerations, giving some additional guidance in terms of implementing what the original ASU was saying about being a principal or an agent and how you would recognize revenue in either instance. ASU 2016-10 actually touches on 2 of the different steps in the revenue recognition process. First of all, step 2, which has to do with identifying those performance obligations. There are some assessment is not required for goods and services that are immaterial in the context of the contract, and also certain shipping and handling activities also do not need to be assessed to determine whether they're distinct. Secondly, ASU 2016-10 talks about software licensing and how revenue recognition should work in that situation. So that's really touching on step 5 when you're recognizing revenue, either over time or at a specific point in time. ASU 2016-11, not too much needs to be said about that. Since Topic 605 went away, certain SEC guidance related to it has also been rescinded. ASU 2016-12, narrow scope improvements and practical expedience. So as stakeholders and readers have gotten a chance to take a look at ASU 2014-09, some questions have already arisen. How do I apply this certain thing? I'm not sure how this should work. This seems like it will be very complicated. So as a result, the FASB did issue this ASU, and ultimately the aim of these is to simplify certain aspects of that original guidance. So there are additional ASUs expected that will continue to clarify, hopefully simplify, and help us along the way. And also on this same slide, but just to be clear, this next thing I'm talking about is not FASB related, it's AICPA related. So the AICPA has formed industry-specific task forces for 16 different industries. We have a few listed there on your slide. And these task forces are in the process of developing accounting guides that will help industries which had their own specialized guidance before, help them apply this more generalized or more conceptual revenue recognition 5-step model. So these, again, this is AICPA, so it's not expected to be authoritative guidance, but at the same time is expected to help these specific industries with implementation. So in terms of a summary and some takeaways, sadly, this new standard is not going to go away. So if you're still in denial, time to move on to the next stage of the grieving process. And you'll see the quote there. The FASB is basically saying, unless something extraordinary happens, something crazy happens, there's not going to be any further deferral of this guidance. So it really is now on the horizon. We've also seen, again, since this ASU was issued, there has been a lot of additional technical guidance being issued. We expect more of that to happen. We also expect these industry task forces to be of assistance for these specific industries where more help is expected to be needed. And finally, regardless of the industry that you work in, it's time right now to evaluate the kind of impact that this standard will have on your company or on your organization. We've talked about the accounting, we've talked about the disclosures. There may be more to think about in the area of IT. Your accounting software, your chart of accounts, is it set up to be able to handle these kinds of changes? Your internal control structure. Who should be involved in this revenue recognition process and determining how this guidance should apply to you? I would encourage you to think of not only including your accounting folks, but also your legal team, your salespeople, because they're really the ones that are dealing with these contracts and how they're written. In terms of transition, you do have two options, a full or a modified retrospective approach. And it's something to think about even at this point. Do I want to do the full retrospective, which means you're going to have to be thinking about this even sooner, implementing it, quantifying it even sooner? Or do you want to stick with that modified method, which gives you a little bit more time? So that was all I wanted to cover on revenue recognition this morning. Jeff may have some additional thoughts and is going to wrap up with some additional guidance.
I think just it's important to look at the key takeaways Erika presented, and that is that the statement isn't going away. We've enjoyed the deferral so far. We get to learn from the public company application, public companies applying the standard, but it is now time for the private companies and nonprofits and others to really start thinking about it and planning it. And I think the different transition approaches are really important to consider. I think one is clearly easier than the other, and I think what you'll be looking at is a combination of data availability. Do you have access to the data to actually do the conversion? And also, as Erika mentioned, will you have adequate internal controls over the data? and the processes regarding the additional elements of the new revenue recognition standard. So with regard to potential changes to GAAP, there really are fewer that we want to talk about this year because we were talking about leases and other things along those lines in the past. But there are always many exposure drafts outstanding on many topics, and always several joint projects between the FASB and the IASB. So I'm the one that made the mistake in the past of reading too many of the exposure drafts. And then what happens is when the real one comes out, I can't remember what was in an exposure draft from this year or that year and what's in the real statement. So I've now adopted my evil ways, and I merely read the summaries to the exposure drafts and some of the comments and trying to confuse myself less. But there are always many out there related to revenue recognition, as Erika touched upon. There are typically some out there related to benefit plans. The nice thing about the benefit plans ones is they all tend to be helpful and simplifying in their context. There are several relating to tax treatment and tax disclosures. There are exposure drafts relating to the subsequent measurement of goodwill, and I think we'll see continued discussion on that. And then there are always a few related to things like fair value derivatives and hedging, the improvement of the cash flow pronouncement that came out recently, along with footnote disclosures in that regard. I think the nonprofits will have a stream of exposure drafts and statements to follow what was issued in August that will relate to nonprofit consolidation and other matters. So with that, we thank you so much for your time on the GAAP and ANA update.